Welcome everyone, and welcome to our options trading series. This is Michael Burke, and we'll get started in just a minute. If you're new to this series, this is actually a 12-part series presented by Larry McMillan and Price Headley, covering a wide range of topics related to options trading, designed to help you understand the options market and options trading more effectively, really to help you with your options trading. This is actually the sixth session in the series of 12, so there's still quite a few left between now and the end of the year. Plus, any of the ones that you've missed are available for on-demand viewing on our website. So definitely take advantage of that. Keep in mind that the following presentation is for educational purposes only. All the symbols and trading ideas discussed are for educational purposes and not recommendations. Active options trading is not suitable for everyone. Please read the disclosure information on the TradeStation website, especially the characteristics of risks and standardized options, also available on our website. All of that information is also available here in the important disclosures that I'm pushing into the chat at this time. So make sure you take a good look at all of those. Today, our presentation is bull spreads, bear spreads, and calendar spreads presented by Larry McMillan. Of course, many of you know Larry as the author of Options, a Strategic Investment. Larry's been a long-time friend of TradeStation and does a lot of seminars for us at trade shows and online, and it's a privilege and honor to have him share his experience and knowledge with us. So, Larry, it's all yours. Take it away.
Thanks a lot, Mike. All right, today we're going to be talking about bull, bear, and calendar spreads, which are three of the more common types of spreads. We'll look at them, not completely in an elementary fashion. There are some nuances to these types of spreads that make them a little more difficult, perhaps, than you might just routinely suspect. Just a quick word about our company. There's three parts to our company. We have research, which is mostly passed along in the form of our newsletters, but which are several. We manage money in the individual accounts in the option market, and then we also do a certain amount of option education, such as this seminar today. If you want a PDF of this seminar, it's downloadable at this link, optionstrategist.com/TS for TradeStation, and there are some offers on our other products there too. Actually, fairly large discounts on most of our other products exist on that page as well. All right, let's get started. We're going to be talking about bull and bear spreads first, and they're really, this is the same thing. They're also called vertical spreads. They're sort of the inverse of each other, as you might suspect. We'll look at when it makes sense to use those. Personally, I think they're greatly overused by most people. We'll look at some of the problems that they have, particularly in the form of expansion when the stock moves in your favor. We'll look at some type of this spread called credit spreads that some traders prefer. And then we'll look at a combination of the two, which is actually condors. And the new condors are actually available as a new single entity option created by the CBOE just recently. So we'll take a look at all of those things. Then we'll look at calendar spreads, which are also called horizontal spreads. And there's a lot of different ways to look at calendar spreads. So I'll show you the way that I look at them. I'll show you how I view the profitability of these things. And then we'll get a little more sophisticated by looking at dual calendar spreads, which is something that we often use in order to look at earnings reports and things like that. Now, you can see here, I said these are called vertical spreads, and these are called horizontal spreads. Those terms go all the way back to the newspaper days, when in the newspaper it used to list a strike and then each month's options across the page like that. So the various months, let's say June, July, August, were listed horizontally. So a calendar spread is a spread between options in different months, so that's a horizontal spread. Whereas if we went down various strikes, the options would be listed down the row like this, in other words, vertically. So those two terms actually date back to the way options were listed on the internet. I mean, I'm sorry, in the newspaper. On the internet, they're not necessarily listed that way anymore. So, you know, those terms might seem a little foreign to you if you hadn't thought about where they came from. A bull spread, very simply, is we buy an option at one strike and we sell an option on the same underlying in the same month at a higher strike. So, you know, for example, we'll buy, you know, say 10 IBM, you know, Jan 250 calls and sell 10 IBM Jan 260 calls. Something like that would be a bull spread. We can produce a bull spread with either puts or calls, but we normally do it simultaneously. In other words, we'll put on both sides of the trade simultaneously via a spread platform or a spread order if you're giving the order vocally to anyone, you know, like a broker. If you don't do them simultaneously, then that's called legging into the spread, which then exposes you to all kinds of vagaries of execution. If you leg in profitably, you feel like you're a great trader, but if you leg in poorly, you sometimes can get locked into a trade that you really probably didn't want it on at that price. So it's just much better if you've decided you're going to do a spread, really a spread of any type, just go ahead and put it in as a spread order with a limit on it and get it executed at your limit, and then you've got the position on that you want without trying to be a hero or a fool by legging into it. As I said, we were buying a call at one strike and selling a call at a higher strike. So this form, we'll say with XYZ at 32, this is a debit spread because a call at a lower strike, say it might cost 5, and a call at a higher strike is always going to cost less, it might cost 2. So that we would be buying that spread for a 3 debit. So when we do them in that manner, they're debit spreads, and often this is the way that they're done because if you have a bullish opinion on the stock, as we'll see in a minute, that's how you manifest it. On the other hand, we can create a bull spread with puts. And again, it's done the same way. We buy the lower strike and we sell the higher strike. So again, it's the same thing. We sell, buy and sell the same quantities on the same underlying. But now if we use puts, this is a credit spread because a put with a higher strike is going to sell for more than a put with a lower strike. So this would always be a credit spread. We'd be buying this one here and selling this one. So in put terms, it's a credit spread. Now, in reality, if we look at, here we're looking at the XYZ Jan 3035 call spread. If we looked at the XYZ Jan 3035 put spread, it should be the exact inverse. In other words, if we're paying a 3 debit for this one, then if we did the equivalent put spread, it should be a 2 credit. In other words, there's really no edge one over the other. Now, in the actual marketplace, there might be a few pennies edge, but there's really not going to be any real difference because arbitrage is always available and market makers will snap up arbitrage opportunities before you as the public can ever possibly do them. So in reality, there's no particular advantage of the bull spread as a debit call spread or the bull spread as a put credit spread, at least not in the general sense. Now, some people, as we'll see later when we talk about doing a credit spread strategy, some people prefer to use the credit spreads in that situation. But here, if we're just talking about where the stock is maybe located between the 2 strikes and we're looking for a movement in our favor to create profit from the spread, then there's really no difference between the two. Here's a profit graph of the spread, and the bull spread, if we have the lower strike, let's see, again, we're just talking 30, 35. So let's just say if we were buying calls at 30 and selling calls at 35, below 30 we would have limited risk because whatever we paid for the spread, that is our entire risk. So if we paid $300 3 points or $300 for the spread, that would be our entire risk. On the other hand, we have limited profit because above 35, we're both long a call, the 30 call, and we're short a call, the 35 call. So the best we could do up there is make the difference in the strikes, which is 5, less what we paid for it, which is 3, or $200. So above here, our profit's limited to $200. In between, we can figure out what this break-even point is. It happens to be 33 in this example. And in between, below 33, we have some losses, but not the maximum loss until we get down to 30. And above 33, we have some gain, but not the maximum gain until we get above 35. Now that picture, that straight line there, is at expiration. Prior to expiration, different things can happen. One thing you should do whenever you're thinking of using a bull spread is just compare it to the outright purchase of a call. In other words, in that last spread, we were paying whatever. Say we were paying 4 for the lower strike and receiving 1 for the higher strike for a net debit of 3. But perhaps we'd be better off just to buy this call for 4 and not bother selling this other one for 1, because if the stock gets up here, up in this range, and starts to really take off for us, the sale of that high strike call really is holding us back. It limits our profit. And what did we really gain from it? Well, we gained 1 extra point if the stock doesn't take off. But if you're doing a bull spread, you do make money to the upside. That's where it gets its name. And if you're bullish on the stock, perhaps you shouldn't be doing a bull spread. Maybe you should just be buying a call outright. So it often pays to consider, if I'm doing this bull spread, what would it look like if I didn't do the bull spread? In this particular case, this stock price right here where they cross is 36. If this was 30, if you thought there had a good chance to go above 36, then I would not do the spread. And in fact, as I said before, there's really probably too many people are doing spreads when they really shouldn't be. So, to repeat, most of the time, if you're bullish on the underlying, the call purchase is the better strategy for several reasons. One, you've got this unlimited profit potential, but also you have immediate expansion. We'll talk more about that in a minute. But a bull spread will not necessarily expand right away when the stock starts to move. Yes, if it's near expiration, it will, but if there's a long time before expiration, it may not. And then finally, remember, if you're doing these spreads, and any kind of a spread, really, you are limiting risk. And as soon as you limit risk, you limit profits as well. Now, there's nothing wrong with either one in the right situation. But a lot of times, traders think, well, I'll put this bull spread on because it seems so inexpensive, but then it doesn't really make you any money or make the kind of money you would expected when you get a big stock move. And that's very disappointing. If you're correct on the stock, but you've chosen the wrong strategy. So, in my opinion, this strategy is overused. I mean, if you watch the option shows on television or something, all they do is spreads. I mean, every single position they recommend is a spread, which is just silly. I mean, it's just not that way. In my own personal trading, and I'll show you more shortly here about how I value these things, but we rarely use spreads in our newsletters. Yes, we do. Sometimes they are appropriate. The vertical spreads, especially. Calendar spreads is a little bit different thing, but the vertical spreads, I think, by most traders just tend to overuse them. They fall in love with selling this out of the money option, which they consider to be like free money, and when it turns out to cost them a lot, then they're not happy about it at all. So when is the best time to use a bull spread? Well, the best time is when the options on the underlying are overpriced. And what does that mean? Right? I mean, that could be a matter of opinion, right? Well, not really. When we say an option is overpriced, it generally means that it's trading with a higher implied volatility than it normally would have. And you can, if you're looking at the TradeStation platform or other platforms, you can see generally what the implied volatility is of the option you're going to buy, and then compare it to, what's the normal implied volatility for options on the stock. That information is available. If you can't find it anywhere else, we have a free file on our website that a lot of people just refer to. We only update that once a week for free, but it's there. It doesn't cost you anything. You just go in and look. And so if you're looking, let's say you're looking to buy, options on something that's going to report earnings this week, and you suddenly see the options are very expensive. This may be trading with a 50% implied. And you go look and you say, well, normally options on this stock trade with a 30% implied. So now that might be a case for using a bull spread. So let's say here we have some stock, XYZ, trading at 50, and we know typically that the implied volatility on these options on XYZ is 35. We'll change the color here. And yet, in this particular case, we are looking at the Jan 50 call, and it's trading for 6 points, which is an implied volatility of 50%. So that's expensive. That's what I mean by overpriced, by expensive. We don't really use the term theoretical value too much anymore. I know I've been trading options since they first started trading in 1973. And in the beginning, we had the Black-Scholes model had just been invented in 1972, and everybody thought, well, this is going to be great. We've got a really good opportunity here to, we'll look at if the options are overpriced, we'll sell them. If they're underpriced, we'll buy them, and we'll just get rich. Well, it turns out that that was a great plan, but in practice it broke down because we didn't know what volatility was going to be. So unless you can accurately predict volatility, you don't really know what the fair value of an option is. And in this particular case, we don't know either, but we can certainly see that these options are trading for much higher than the normal. So when that happens, I might look for an option to sell against it. So now here I see the Jan 60 call. It's trading for 3, and it has an even higher implied volatility. So that would be my ideal situation. When the out-of-the-money call has a higher implied volatility than the at-the-money call, that's called a skew. And in this particular case, a linear skew or a forward skew. But you can see that I'm sort of selling something that's a little more expensive than the thing I'm buying, but both are more expensive than the underlying stock's history of options on this underlying stock would indicate. So this is the kind of situation that I might consider buying a bull spread. Now, you would need to look and find out why. If it's because of earnings or an FDA hearing or something like that, then that's why the options are all pumped up. But if it's just because, the stock has kind of been running and it's hot and, I don't know, it's been mentioned on TV or something, whatever, some newsletter guys recommending it, who knows? There's a lot of different reasons. Then the skew, looking for expensive options with a skew would be a more attractive situation to own a bull spread there than I think than just ordinary calls. So in this particular case, these options are both expensive, the implieds are higher than the historic implied, and they're skewed. Well, just because you have that doesn't necessarily mean that things are going to work out for you. I mentioned the expansion problem. And the expansion problem in a spread is that, recall I said at expiration, your profits are going to lie along this line. But if you buy a spread that says it's got, 3 months to go, and the stock starts to move for you, after 15 days, your profits aren't going to be anywhere near that line. Let's say the stock moves up 5 points, and you're going to be along that line. So maybe you make $1 or so, and instead of the $3 or $4 that you thought you would make at expiration. So the stock moves a little higher again. You're getting closer, but these two lines won't converge till way out in the future there somewhere, way out to the right. And as a result, you might be tempted to stick around in a trade far longer than you're really going to be welcome. Eventually, something happens, the stock falls back, and you really didn't take much profit at all. Now, after 30 days, that line starts to move up. I'm going to just concentrate on the line. I'm going to back it up, see how it's lower, and then I'll come forward, see how it's higher. So after 30 days, you're a little bit closer to that line, but still not so close. I mean, again, here, if the stock moves up, in this particular case, about 7 points in 30 days, you're only going to make about half of what your eventual maximum profit is. half being half the distance from here and then there. If it takes a little longer, say 60 days, okay, now you're getting closer. Now that curved line is beginning to hug up against a straight line. And if you want to think of it in mathematical terms, it's going to be asymptotic to that, coming up towards it. And then finally, of course, at expiration, it would hit the, up along this line. So if you're doing a real short-term bull spread, then fine. Then, there's not many days left till expiration or anything that's going to start to hug that straight line right away. But if you put on a bull spread that's got several months to run, or any spread with several months to run, it's not going to reach its maximum profit potential or potential either, at any time, in the short term after you put it on. You've got 60 days or 90 days to go when you put the spread on, and you start to get that short-term move. You're not going to really see, much improvement in the spread until you get out closer to expiration. Somebody said, where do you see the typical implied volatility? I'm going to do questions at the end, but I'll just say this to you again. I'm sure that's somewhere there on TradeStation. I'm not exactly sure, but if you can't find it, if you go to our website, we have the average implied volatility for everything that trades options. It's a free file that's updated once per week. All right, so how can we counter this expansion problem? Well, first of all, we could do short-term bull spreads. But, not every trade you put on, you want to be short-term. You might want to give it some time to work. So the way to counter that is to spread the strikes farther apart. And this is something that, again, most people miss the point here. They put on a bull spread, and they often do just a 5-point bull spread because the debit seems really low. And it seems like such a good idea. You can put it on for $0.50, and it could spread out to 4.5. But in reality, if that's really the case, it's not going to start spreading out to 4.5 for a long time. So if you spread these strikes out farther apart, you'll pay a little bit bigger debit to begin with. But then as soon as the stock starts to move in your favor, you will actually start generating some profits. And we can measure this. We can quantify this with the deltas of the options. Each option has a delta, which tells how fast the option moves with respect to the stock price. So if the delta is 0.5, that means the option will go up 0.5 point if the stock goes up 1 point. So we want to observe the deltas of these options. So we have, a decently positive delta. We don't want some little tiny delta like 0.08 or something in our spread. If we're buying an option that has a delta of 0.5, and we're selling an option that has a delta of 0.4, we're not going to really make much money if the stock starts to move higher over the short term. Eventually, the deltas will change as time passes, but that's something that we definitely. So if I'm doing a bull spread of my own in our newsletter, we'll spread them, fairly far apart. So let's take a look at an example. Let's say you're looking to spread something like Apple, which has not only expensive options, but high-priced options. So here's Apple. The other day it was trading at 700, and here are the various calls. I'm just taking mid price on the market, but you can see the range from 20.5 for the at-the-money call with a delta of 52, and here's your implied volatility of that call. You can see the implied volatilities are pretty much right in line with each other, so there's no skew here. But that doesn't mean just because there's no skew, we can't do a bull spread. But you look at this call and you say, wow, I don't really know if I want to, say, buy 2 calls and spend $4,100. That's a lot of money if things don't go right here. So let me see about selling one of these other things and get myself down. And we'll often quantify this too by saying we don't like to risk more than 3% of our trading account on any one risk trade. So say you had a $100,000 trading account. And so you're willing to risk $3,000 on this trade, but I personally don't like to just do one contract. Then that leaves you no room for taking partial profits or anything like that. So if you're going to buy 2 of these, you've already violated your 3% rule. So you need to sell something against it to make a bull spread out of it. Which one would I choose? Well, I'm just saying this would probably be a pretty good choice because now we're buying this one for 20.5. We're selling this one for 6.5, so that's a net outlay of 14 points, or $2,800 for two of them. The delta we're buying is a 52. The delta we're selling is a 24. So we've got a positive delta here, and we've got 40 points between the strikes. So this two spreads could widen out to eventually be worth 80 points, the difference in the strikes times 2 for two spreads. So we're paying 14 for something that could eventually be worth 80, and it's going to start making some money right away. Unfortunately, we don't have the benefit of the skew, but we can't have everything. So this is how I would look at these sort of things. And, I would spread them out that far so that I can get some delta in this position. I'm going to back up the slide. A lot of people might be tempted. Let's say, well, let's just do this spread. Well, fine. That's great at expiration. But in the beginning, this delta is 0.04, which means if Apple moves up 10 points, you're going to make 40 cents. That's just not what you're expecting, believe me, I'm sure. You would, if Apple moved up 10 points, which would be up to the top of the maximum point of your trade there, you're making 4 cents per point. Yes, the deltas change a little bit as it gets a little higher, but they're not going to expand that much. So my point is, spread them out, spread the strikes out, get your net debit into a range that you can live with. Here we're buying two spreads for it'd be $2,800 plus commissions. So we're within our 3% range of exposure on a $100,000 account, and now we can make some real money with this. Thing can go from 14 to the two spreads could widen out to 80, and if it makes a 10-point move right away, I'm at least gonna make some money for myself, and we will make like $5.60 or something. So a decent percentage return. All right, so there's bull spreads. I mean, if you see how things are on TV in these shows, they're always recommending these things, but I really think they're pretty much typically overused by people. What about bear spread? Bear spread is just the opposite. We buy an option at 1 strike, and now we sell an option at a lower strike. Same month, same stock, lower strike. So that makes it a bear spread. Very similar to the other one. So let's say the stock is 65. With a call bear spread, we could buy the higher strike. We buy the no call, and we sell the lower strike, the no 60 call. And this will always be a credit spread because an out-of-the-money call is going to just sell for less than, this is the one we're buying. It's going to be selling for less than an in-the-money call. So that would always be a credit spread. In terms of puts, though, again, we will buy the higher strike and sell the lower strike. But in terms of puts, it's going to be a debit spread. So, this might cost 5 and this might cost 2. And so we're buying 5, selling 2. A higher strike put is always going to cost more than a lower strike put. And so that would be a debit spread. But again, as with the bull spreads, as long as the stock is kind of near the strikes, in between the strikes, what have you, there's really no difference between the bull spread and the bear spread. I mean, the put spread and the call spread. So this is how the profit graph looks for a bear spread. And it's just basically the bull spread thing spun around on the axis 180 degrees, and limited loss, limited profit, same, very similar type of thing. So again, the criteria would be if you're bearish on a stock and you really have a bearish opinion on this thing, you're probably just best to buy the put outright. I mean, there's nothing wrong with doing that unless they're very expensive or there's a skew, and then you might want to consider doing the bear spread. Again, you would spread the strikes fairly wide apart for that same reason, to create some delta in the position so that you're not just you're watching the stock drop and not making any real money because you've got your two options of moving at almost the same rate. Now, there's a variation of these that's called the credit spread strategy that a lot of people really like. And generally, when you're using the credit spread strategy, you use out-of-the-money options. In fact, sometimes very deeply out-of-the-money options. So you're really not speculating so much on stock movement. In fact, you'd love it if the stock never went anywhere. You're basically hoping to sell these out-of-the-money credit spreads and hope that the stock really doesn't move too much, and therefore you collect the premium, they expire worthless, and you move on to the next one. And that's the theory. We've done a lot of research on this, written articles on it, what have you. Frankly, it's not my style of trading. It's just a little bit too laid back. It works a lot of the time. I mean, you might see these articles where people say, "Oh, we make money on 95% of our option trades." Well, this is probably what they're doing. Let's say here's a stock at 85. Here's a deeply out of the money put, 25 points out of the money, selling for $1.10. And we'd like to sell that put, but if we just sold it, this is a volatile stock. It could collapse. We could get in trouble. So we'll buy this even farther out of the money put for 70 cents. We'll take in a net credit of 40. And as long as the stock is above 60 at expiration, we will make our 40 cents. So there's a lot of risk to the downside and just a modest gain to the upside. Here's the break here. This is just plus 40 cents here. But we're starting out with the stock way up here at 85, and our break even here is 59.5. So, and not only that, since we bought this lower strike, we've got the bottom, we've got the risk cut off here. So the worst we could do would be lose $4.60 in that spread, which would be rather devastating if it happened, but still it wouldn't be a huge or double, triple loss of our capital. The problem, well, the advantage that people like with these things is there's a high probability of success. As I said, maybe 90 or 95%. What's your margin here? Your margin is 460, which is your risk, which is 100% of the capital you're putting in the trade. And this is what people sometimes forget with these things. So if you put your entire account into credit spreads, and then the worst happened, you could wipe out your entire account. And believe me, when you have the financial crisis of October 2008, or you have the flash crash of 2010, or you have the market down 14% in a week like you had in August of 2011, people got hurt in this strategy, and sometimes hurt very badly. In fact, in 2008, people got wiped out in this strategy. So you need to be careful. It's probably like anything else. You can't put all of your money, all of your eggs in one basket. But the maximum rate of return, if you got it, you make 40 cents on a $4.60 investment. That's 8.7% before commissions in 5 weeks. And if you analyze that, that's a pretty good rate of return. So, that's why people like it, and it can do really well for you for quite a while, and then all of a sudden you have that one bad one, and then you wonder, why was it ever doing that in the first place? There are other problems associated with the strategy, and you can get 5 people that trade these in a row and ask them how they adjust them, and they'll all tell you something different. Do you adjust when the stock falls to the higher strike so that you don't, in that particular one we were just doing, the higher strike was 60. The stock starts out at 85. Stock starts to fall. When it gets to 60, is that where you adjust? You get out of the spread now before things get really bad? You're going to have a loss if you do that. Or do you wait until it falls, say it falls below the lower strike, 55? Well, I'll get out now. Or do you not do anything unless the stock gets down here and it looks like you're going to get assigned? Or do you never do anything? You just wait till expiration and take your chances that it won't be down here, that even if it goes down here, it'll come back before expiration. Believe me, there are people that espouse all these methods. Frankly, I'm more of the kind that I'd like to, if my probabilities were good to begin with, then I'd probably just let it go. But I would not be 100% in the strategy either. So I think that influences your opinion. I'm not telling you which is right or which is wrong, because I don't think there is one here. It's something you have to live with. You have to, any strategy, you have to be comfortable with it yourself. And this, I find this strategy rather hair-raising myself, but whatever. A large percentage of winning trades can be wiped out by, a few disastrous losers. So when you see these statistics and people say, well, we made money on 95% of our trades, take a close look, because it might be this strategy. And how did those other 5% do? Because if you're making 40 cents 9 times and you're losing $4.60 once, that's not a positive number, folks. So, even if you're making 40 cents 95 times out of 100, it's still going to be close. So all I'm saying is I think this strategy is a lot more difficult, nerve-wracking, and time-consuming than its proponents often give it credit for, or give it detriment for, I guess I should say. But by and large, if you're going to do this strategy, do not put 100% of your money in there. We were running a condor selling strategy in our newsletter for a while, and we had done back testing. It turns out you can do about 50% is about the most you can do. And so if you ever do get wiped out, you still have 50% of your capital left. If you get wiped out twice, you still have 25% of your capital left. It's better than getting wiped out altogether. So if you're going to pursue that strategy, you can't do it with your entire account. Now, what if we combine two kinds of credit spreads? So the one I was showing you there was a put credit spread, but there's a call credit spread is the same thing. So suppose S&P is trading around 1,400, and people like to use the S&P or the spiders because they're very liquid. So one credit spread here we could do with puts is we buy the lower strike and sell a slightly higher strike. And then we could also do one with calls. We could buy a higher strike and sell a slightly lower strike. So that's a credit spread on both sides. And when you do that kind of a credit spread, or double credit spreads, you get a profit graph that looks like this. And let me just get the black, I guess. So it's this line right here. Down to here, and then over to there. That's the condor. It's called a condor. And it can be regular condors or iron condors. They all have the profit graph that looks like that. And people like to do those. So you sell those, usually, S&P's in the middle, and you hope that it doesn't go outside the range. And if it does, you would have the loss and blah, 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 all the wonderful things that might happen with it. Well, the CBOE, attempting to capitalize on the popularity of this strategy, I think they're finding it's not quite as popular as they thought it was, but they put together what's called a range option. So, and in this particular case, it's a S&P range option, and it trades with a symbol SRO as an index on my systems. And what they've done is, by just stating that we're going to trade one call, so in this particular case, if you go into the marketplace there and you can buy one single range option OCK35 call. And what do you really have? This is what you actually have. It won't appear this way in your account, but this is what goes on behind the scenes with the guys making the markets in it. They're along the lower strike, the 1365 call. They're short the 1375 call. Oh, this should be 1. I don't know why that's 2. They're short a 1425 call and along the 1435 call. And when you do that, you've got that exact same profit potential, like that same trapezoidal looking thing, condor, whatever you want to call it. So this single range option has this kind of profit potential, and it trades as a single number. So in this particular one at the CBOE, I took this graph off the CBOE's document talking about this. You have a maximum risk of 2 points. Here, your maximum risk is 2. You could make as much as 8, and again up here you could lose 2. And so if you buy this call, then you would want the thing to finish in this range across here, and it would eventually be worth 8. If you sell this call, you want S&P to move outside the range, and you would pick up your 2. So as a seller of the condo, you want it to be outside of that range. And the most recent newsletter that we put out discusses this in a fair amount of detail, but it turns out, I think it's an interesting product, but open interest is very, very tiny. But this is how they look, and it's sort of interesting to think about it this way. We were coming up on September expiration when I looked at these prices. September expiration was the 21st. And with S&P at 1435, the 1280 call let me just back up 1 second. Notice that when it's called a 1365 call, the highest strike is 1435. That's 70 points away. So here, the 1280 call, the highest strike is going to be 1350, while S&P is way above that. So basically, the thing is almost worthless. It's outside of that range. And the 1310 call, same sort of thing, outside the range. 1340 call, now your high strike is 1410, and now the option, the SRO is worth maybe $1. I'm going to erase some of these. I don't want to get to. At 1370 now, things become a little more interesting. The highest strike now is 1440. Now you're within that range, and now the option is definitely worth something if you're long it. So you're within the high end of the range. Now you're right in the meat of the range if this is the 1440 one, because it extends up to 1470. And while it could expand to 10 at expiration, it's worth 7 there at that point. And then as it gets too high, it falls back off again. If you look at farther out months, here the 1400 is your best one because it's right between the two strikes. As September is selling for 7, October for 380, and November for 250. So the calls going out in the future, because it's a spread, it's not really, they call it a call, but it's really a spread, they are selling for lesser price because there's more of a chance that the thing can move outside of the profit range and your call could expire worthless. So if you like condors, and if you like that sort of trading, I think this is actually a much better way to trade them. It's, first of all, I think cheaper, and you don't have assignment risk, you don't have all those other kind of things going on, and you can buy the call or sell it, however you want to play it. And if you sell it, you just have to put up the margin of 10 points less what you sold it for. If you buy it, you just have to pay you just have to put up what you paid for it, and you can trade this. I mean, it will go up and down as the market moves or as time passes, or you can just hold them all the way to expiration. So it's, I think, actually a more efficient way to operate the condor strategy. Unfortunately, I don't think too many people are taking advantage of it yet. But you might want to take a look if you like the condor strategy. All right. Let's go on to calendar spreads. This is what I call a low volatility strategy, which that just means it's best put on when volatility is low, because once it's on, you'd like volatility to increase. But if volatility is already very high when you put it on, it's not such a great strategy. I'll show you why. It can be designed as bullish, bearish, or neutral. So most people think of it as a neutral strategy, but it doesn't really have to be. And it's best when a skew exists, in this case, a horizontal skew. So let's look at these. First of all, what is a horizontal skew? Well, horizontal skew just means that the near-term options, usually it's the near-term options, let's say in this case, XYZ is trading at 41, and we're in, let's say, August. So we look at a SEP 40 call, and it's trading with an implied volatility of 60%. And then we look at a DEES 40 call, and it's trading with an implied volatility of 49%. So we'd like to sell this more expensive volatility and buy this cheaper volatility. This is a skew because there are two options on the same stock, but they're trading with distinctly different implied volatilities. And so a typical calendar spread here might be buy 10 of the DEES 40 calls and sell 10 of the SEP 40 calls. Very simply, here's the prices. So it would cost $1.50 per spread. So that's a skewed situation. We'll talk a lot more about the skew actually in a minute, but let's talk more about the profitability of the spread first. We can put it on with puts or calls. In the traditional sense, this is an attempt to capture time decay. In the more modern sense, not so much, but it gets its name called calendar spread. Sometimes these are even called time spreads, because the near-term option decays at a faster rate than the long-term option does. So if you buy, in that last spread, we're buying the DEES 40, we're selling the SEP 40, the stock just stays there at 41. Eventually, that September option will start to decay faster than the December option does, and the spread will widen, and you'll have a profit. So that's the essence behind the strategy in a lot of cases. It becomes more sophisticated when you're actually trying to predict where the stock is going to move, or if you're trying to analyze why there's a skew in the options. But in the simple form, it's a time decay strategy. It has both limited risk and limited profit potential. although it can have big percentage returns. You can't lose more than 100% of your money as long as you don't leg out of the spread, but you can sometimes make more than that. And it's best established, as I said before, when the options are cheap, when implied volatility is low. Let's we'll get to that in a minute, but sometimes, I remember when I first heard about these spreads back in, I'm going to say 1973, and one of the old timers said, well, you have to be right twice in this spread. I said, what? And he said, yeah, because you want your near-term options to expire worthless, then you want the stock to make a move, and the long option you hold will then make a lot of money. And I said, well, that's not a spread strategy. That's just like a double speculative strategy or something. So you really don't want to look at these spreads that way. Rather, you want to evaluate them as a spread, putting it on as a spread and removing it when the near-term option expires. If you decide to hold after that, that's up to you. That's fine. You can try it if you want. But in order to analyze these credit calendar spreads, you really need to look at them as a spread. A lot of people like to start out with the stock near the strike so that if the stock goes nowhere, then you're going to make money. And that's probably the most popular way to put them on. And there's nothing wrong with that. Although, what are the odds of the stock really not moving too much? Probably less than you would think. In any case, let's suppose that we've put on one of these spreads. So sometime back a while ago, we put on, let's say we bought some July options. We bought the July 50 call, and we sold the April 50 call. And we maybe paid, let's say we paid a 3 debit. So the way that I would like to look at these spreads is this way. What's the profit graph at April expiration, the near-term expiration? And here it is right here. So if the stock drops badly and all the calls expire worthless, we would lose our debit of $300. On the other hand, if the stock goes wildly to the upside, all these calls are going to start trading at parity, especially in a low interest rate environment like we're in now, and again, you would lose your $300. But in between and near the strike, there's going to be a profit. So if on this last day, the stock goes right out here at $49.99, the April call is going to expire worthless. And what's the July call going to be worth? Well, we don't know. How could we know? It depends on what the implied volatility of the July 50 call is at that point in time. So if we bought when volatility was low, odds are volatility is going to be the same or higher by the time we get to April expiration. And so if volatility went up, we could have a really nice profit. That July 50 call could be all pumped up if volatility was high by that time. On the other hand, when we entered this spread, if we overpaid, if we paid too high of an implied volatility for the option we bought, and we were getting a high implied volatility for the option we sell, but if we paid too much for the one we bought, when we get there to expiration, there's a good chance that thing is going to have lost a lot of its value. And therefore, this spread, even though it looked so attractive on paper, might not have worked out. And if you've done calendar spreads and you put them on when the options are expensive and then not made any money, you might think, why? But this is why. So it's very, very important to not overpay for the long-term option in these spreads, and I mean overpay in terms of implied volatility. Okay, so here's my calendar spread criteria. Other people have their own. You do like you want, but I've found this to work fairly well over time. First of all, I don't want the options to be separated by more than 4 months. I'm not a fan at all of buying leaps options and selling near-term options against them. You may think of that something other than a calendar spread, but it's still a calendar spread, and you're paying a huge debit when you do that. And if the stock takes a big move on you, that debit is at risk. And yeah, if the stock just sits there and you keep churning out near-term options, selling them and they're expiring worthless against that leaps option, that's great. That's fine. But odds are that's not going to happen. And even if it happens for a few months, there's going to come some time when the stock makes a big move up or down. As soon as that happens, that strategy is not so good. So I don't like the options to be more than 4 months apart. I would also like the near-term option not to be expiring tomorrow. Now, with weekly options, there's a little bit of a module load. I will allow for the fact that, yes, If you just sell the weekly options and roll them over all the time, then perhaps that's sufficient. Implied volatility, again, I'd like it, as I said, I want them to be fairly cheap, at least in the 50th percentile or lower, perhaps even lower than that. And then I'd also like to have a skew. So I'd like the near-term option to have a implied volatility about at least 10% higher than the longer-term option that I'm buying. So I'd like there to be a horizontal skew. So you can find a lot of these. It's not that hard to satisfy all these criteria. The problem is, why do they satisfy it? And we'll get into that in a minute. And we have an area on our website called the Strategy Zone where we rank these things by expected return, which is a mathematical way of looking at it. And you can look at them by how much money they can make for you, and you'll see some pretty big numbers like in this particular example here. This is annualized expected return, numbers in the 150% range. Obviously, those are probably something inflated in terms of biotech stocks or something going on. And we'll talk more about that in a minute. You can also look at them in terms of how likely they are to make a profit. But when we try to find these skews, what's causing the skew is very important. So we need to look at that, because if we think calendar spreads are attractive because there's a skew, and we think at-the-money calendar spreads are the best ones to do, then it's unlikely that this is going to happen. I mean, the reason the skew is there is because the option market is thinking the stock is going to make a move. It might be from an FDA hearing, it might be from earnings, it might be from a lawsuit, it might be from, just speculation, bear market or what have you. But in general, the bigger the skew, the less likely it is that the stock is going to be unchanged. And therefore, while the mathematics might line up right and you put all the numbers in, the computer that's doing, let's say, a log normal distribution analysis of your spread doesn't understand that this stock could move. And it's probably quite likely to move. Now you can, I guess, build a computer smart enough to do that, but most of the analytical tools you have at your disposal are not geared for that. So if we expect some large move to take place, then what do? Well, we could just say, all right, well, I'm not trading that one. And then you go down the list and down the list and down the list until you finally get down low enough where you don't have those things. And now the returns are actually quite low, and you're dependent, again, still on the stock, pretty much staying unchanged. And it can move even if there was no skew. But suppose that we say, well, I'd like to maybe try to take advantage of the skew. So I look at the skew. Let's say it's caused by earnings. You could say, all right, well, if I think the earnings are going to be positive, let me put on a calendar spread. Well, let me use a higher strike, and then I think the stock is going to move up, and it's going to go to the strike. Or if you think the earnings are going to be bad, you could do an out-of-the-money put calendar spread. So if the stock fell to the lower strike, then again, you would make the most money. In other words, a calendar spread will always have its maximum profit at the striking price of the calendar spread. That striking price does not have to be near the initial stock price when the spread was placed. So, if you think the earnings are going to be good, you could buy an out-of-the-money calendar spread, or you think an FDA hearing is going to prove positive for some small biotech, you could do the out-of-the-money call calendar spread and profit very nicely if the stock rose to the strike. On the other hand, you could say, look, I have no clue what these earnings are going to be or what the FDA is going to say, but can I still give it a shot here? And yes, you can. You can actually do both. Do an out-of-the-money call calendar and an out-of-the-money put calendar to try to take advantage of the skew and the movement that's going to take place. So by doing two calendars, you've got the benefit of the skew, and one of them you hope will max out, the other one will minimize, but you hope that together the two of them could make some money. So this is what I call the dual calendar. And in this particular case, the strike price of the, let's see, this one, I guess looks like we've got the 110 strike here. So you're going to have a peak where your calls go out and then a 90 strike where your puts go out. And if you want those two peaks to balance out, you just do some more puts than calls. So if you're doing, 4 call spreads, you do 5 put spreads or 6 put spreads. Run it through a model. So that's the theory of the dual calendar. We do these fairly often. I mean, this is one that we did at one point in time. Google was right between the two strikes. It was trading right around 420. And the near-term straddle on Google was selling for, I believe, 35 points or maybe 40 points, so that we did a strike 40 points higher, so 460, and we did a strike 40 points lower, so 380, and that gave us our two potential peaks. We did 5 call spreads and 7 put spreads. It was a fairly large debit, but it was a larger trading account. And in fact, what happens is the stock immediately, it fell the next day right down in this area, and the spread made money, not its maximum, but it made money pretty much right off the bat, and we exited like just a few trading days later for a decent profit. So this is the kind of thing you can do if you feel comfortable with the option market's estimate of where the stock is going to be after the earnings. By the way, look, you had very little profit if the thing was unchanged, but we don't expect it to be unchanged. We expect it to make a move because of the earnings. When you're looking at these, it's the same problem that I mentioned earlier with the calendar spread, though, is how much will you pay for the long-term options. So here's an example. We were looking at this particular point in time in Merrill options. Merrill was in a downtrend here. And Merrill was in a downtrend. Meanwhile, the implied volatility of Merrill options had jumped way up here because earnings were about to be reported. So we looked at the near-term August options, and they were selling for 100% implied vol. And the October options were selling for an 85. So we could sell 100, buy 85. Well, that sounds pretty good. But when we looked at the long-term, the top chart there is a chart of the implied volatility of Merrill options. Well, here's where 85 is on that chart. In other words, most of the time in history, Merrill options don't trade with an 85. So if I'm paying 85, even though I'm selling something else for 100, I'm probably going to lose money in this spread, because if volatility collapses all the way back down into this 40, 50 neighborhood here, I am going to lose. Despite the fact that I sold at 100 vol and bought an 85. Now, I'd rather have something that maybe looks a little bit more like this. This is another one, MSTR. It's trading down here. Options started to get expensive, again, because in front of earnings. And now in this one, we could sell August options for a 63% implied and buy October options for a 50 vol. Now here, 50 vol, if we look back here, you can see like a lot of the time it spends above 50 vol or near 50 vol. So that one, I'd say, okay, that one I could give a shot. And in fact, we did do a dual calendar on that particular one. So, you need to, again, not overpay for the longer term options in the spread. And again, you need to have some measure of looking at the historic, the implied volatility chart. So how do you exit these trades? Well, you can't exit obviously before the event occurs, before the earnings or the FDA hearing or whatever. Once it happens, if the stock is inside your trading range, inside your profit range, let me just back up a couple. So your profit range in this one is from there to there. So if it's inside your profit range, then you might decide to stick it out for a while, because things could get in better. And in fact, if it expires, gets expiration, near-term expiration, and you're inside that profit range, the near-term options are going to expire worthless. You now own those longer-term options. You could sit on them, being long a strangle, or you could sell the next month against them and sort of reestablish a calendar spread for the next month. But if the thing moves outside of your range immediately, then it's time to get out. So you guys, I say, plan your exit, because sometimes you can't get out immediately, but you need to be looking to get out. Otherwise, you're going to lose your maximum money on that spread. And it happens. It definitely happens. So you limit how much money you're going to put into any one of these trades. But once it moves outside, if you do it early, you won't take the maximum loss to get out of the trade. All right, I'm going to have a couple of minutes for questions. Let me just remind you that The PDF of this presentation is available at optionstrategist.com/TS for TradeStation. And also, I don't know if any of you are going to be at the Online Traders Expo. I guess it's just called Traders Expo now in Vegas in November. But I'm doing a paid talk out there for these expo on, this is actually Thursday afternoon, November 15th in the afternoon, and the cost is $245 for early bird. We are giving registrants over $700 worth of newsletter subscriptions. So in theory, it doesn't cost you anything. I know one thing is hard cash, the other is not, but still, it is that value. You can enroll either on our website or on their website. We'll be talking about volatility derivatives, volatility trading, expected return analysis, and then I'm going to go over the trading systems that I actually personally use, many of which I've published in our newsletters, but not all of them. Some of them are proprietary only for these paid seminars. And just as an example, one thing that you can buy if you go to our website now is our recording of a previous intensive options seminar for about half price. All right, there's my contact information. Let me look at some questions. All right, so someone, why not use bull and put credit spreads? Let me see. Well, I think that's what I was talking about in the Condor, the bull and bear credit spreads. I'm not sure what that is. That's questions pertaining to that or not. But yeah, this Condor that most people set up by themselves, they'll do a put credit spread down here and a call credit spread up here and just combine the two. Do you ever use diagonals? Well, yeah, I mean, the dual calendar strategy is technically a diagonal, but yeah, if you mean, if I want to sell the options one further strike out or something, yes, occasionally. We've looked at doing some of those. I don't know, it seems to me that every time I try that, it doesn't really work out, but definitely diagonal spreads are part of the broad spectrum of trades that we look at. So a diagonal spread just means that you're buying an option at one strike. I don't really have is there a whiteboard here, Mike, to work on or something? I'm not sure. Anyways,
No.
diagonals. What's that?
You have to draw on the slide if you want a whiteboard.
Oh. Okay, well, whatever. It's just, diagonal spread is we buy a call at one strike and you sell a call at a higher strike in a different month. Usually you sell the near-term call, you buy the longer-term call. So they're diagonal. Again, if you think of it as how they're listed in the newspaper, they're diagonal to each other. All right, what else we got here? Okay, somebody's giving me a boost. Yeah, the 5th edition of my book came out this summer, so if you want to cure your insomnia or have something really heavy to hold down your papers, that's a good thing to use. Observations on peculiarity of bull and bear spreads for sectoral ETFs such as XLE, blah, blah, blah. Well, those things, the ETFs, I look at those and we trade them, and we trade things around them, and I like them for broad-based attempts at oil or gold or silver or the euro or what have you. But in general, they have low volatility, and I think that bull and bear spreads probably are kind of wasted on those. I think that's the kind of thing I'd be more or less just happy being along an option or what have you, short an option. Now the silver and the gold, yeah, they get a little crazy. So there maybe bull and bear spreads do make more sense. You ever use an iron butterfly and convert to an iron condor if you need to move your range of profitability? All right, then I'm not going to explain all those terms, but basically it's a follow-up on condor spreads. And, the following up on a condor spread is just, as I was saying, it's difficult, same as like following up on the put credit spread. If things start to get in trouble, you're really kind of backed into a corner. There's not a lot of different things you can use. So this is one strategy that you could roll down into a butterfly spread. I have never done that in my life, but I'm not saying it's not a worthwhile endeavor. I've never actually done that. More or less when I have those things on, I'm just looking for a place to straight get out of them and maybe set up a new one in a neutral manner and not try to milk the one I have on for just because it's already causing me so much grief. I'd rather get rid of that grief and acquire something a little more neutral. Mike, I'll toss it back to you. If I didn't look way back, but I don't think there were any questions before that. Oh, let's see that. Do you use the implied volatility for the entire option month, or the implied volatility in the money for that month? The implied volatility that we post there is called what I call composite implied volatility. It takes into account all the options on that underlying, and it weights them by their time remaining. Near term gets the most weight, and their volume. Volume gets the most weight, and their distance in or out of the money at the money gets the most weight. The formula is actually explained in my book, but so when I was talking about what average volatility was, that's calculated in that manner, what I call composite implied volatility. Okay, and I think that brings us up to, okay, oh, there we go. Do you practice legging out of an IC in trouble? Oh, an iron condor in trouble. I don't leg out of spreads. I mean, that's just, you're already mentally impaired because you're losing, and then you go in and try to do something like that in a, not great mental state. Not usually something that I've found it doesn't work for me. I'd rather just get out of the thing and go on to something else. So, Mike, I'm assuming you're there.
Thanks, Larry. That was great. For those of you who haven't been to Larry's site, there's lots of great content. So that's definitely, if you're going to be trading options, you definitely should check out all the things that Larry has to offer on a monthly basis. This was great, Larry. Thank you very much. Our next option session, we'll be talking about opportunities in weekly options with Price, Headley, and then Larry will be back on October 18th to talk about trading volatility. So definitely don't miss those. You've got Larry's contact information. If you click on the link on the side, it'll take you right to his website. And so thank you very much, Larry. We'll see you again on the 18th. Thank you, everybody, for joining us tonight. Lots of great events coming up between now and the end of the year. Definitely visit the website and check it out. And if you have a couple of minutes to click and take a survey of this event, we really appreciate it. It gives us an opportunity to improve these kinds of events. So thank you, everybody. Have a great evening, and we'll see you again at another event. Thank you again, Larry. That was great.